Welcome to our microlearning channel. The opening slide shows why raw revenue can be misleading. Two companies with very different sales figures can have very different health when measured by margins. The graphic compares a big revenue number to a smaller business with a higher percentage margin. And this reminds us that profitability ratios standardize results so investors can judge pricing power, cost control, and capital efficiency across firms and time. The chart here walks us from top-line revenue down to net income, highlighting gross, operating, and net profit margins along the way. You can see how cost of goods sold and operating expenses sequentially reduce profits, and the slide explains that gross margin measures production efficiency, operating margin isolates core operations, and net margin captures the final bottom line after taxes and interest. This slide links the income statement to the balance sheet by showing three key return metrics: ROA, ROE, and ROIC. The visual bridge emphasizes that ROA measures how efficiently assets generate profit, ROE captures returns to shareholders, and ROIC evaluates capital allocation across debt and equity without leverage distortion, helping to identify whether profits come from operations or financial engineering. The DuPont framework decomposes ROE into three drivers to diagnose the true source of returns: net profit margin, asset turnover, and the equity multiplier. The graphic makes clear that a healthy ROE should come from strong margins and efficient asset use, not excessive leverage. So we should ask whether costs are controlled, sales generated from assets are sufficient, and debt is being used prudently. The two charts emphasize that context matters when evaluating performance over time and against peers. The time series line shows how gross margin evolves internally, revealing structural improvements or deteriorations, while the scatterplot benchmarks ROE across competitors, demonstrating that what counts as a good margin or return varies widely by industry and peer group. The final slide presents actionable levers as puzzle pieces linking revenue and cost strategies to profitability. It suggests improving gross margin through pricing and supplier changes, boosting operating margin with automation and reduced acquisition costs, and enhancing ROA or ROE by optimizing working capital, divesting underperforming assets, or restructuring debt to improve overall capital efficiency.